The regular trading session for the U.S. stock market is currently closed. Nuburu Inc., trading under the ticker symbol BURU on the NYSE American Exchange, concluded its last live trading session on Friday, May 22, 2026 at 4 p.m. Eastern Time at an exact closing price of $0.1969 per share. This final price reflects a notable positive daily swing, with the stock moving upward by 6.20% over the course of the intraday session. While a sub-$1 stock gaining ground on high volume looks like a standard retail momentum play, the underlying mechanics of this microcap tell a far more intricate story. While the retail crowd sees a cheap penny stock bouncing around its historical floor, institutional tracking reveals a sweeping structural pivot away from pure-play commercial hardware manufacturing toward a highly integrated defense and security technology platform. The market assumes this business is simply struggling to survive a severe capital crunch, but a quiet restructuring has completely altered the risk profile of the organization. The baseline expectation for a microcap equity down significantly from its historical highs is that it faces an inevitable slide toward complete insolvency. The broader market narrative surrounding this asset has been one of deep skepticism, driven by previous compliance notices from the NYSE American Exchange regarding low equity thresholds and persistent net losses. Online investment platforms often flag names with going concern qualifications in their annual reports, which scares off casual market participants who rely on standard scanning tools. However, looking past the top-line distress reveals a different reality. The company just delivered an earnings report showing its first major chunk of commercial revenue from newly consolidated international assets and a massive balance sheet improvement that completely erased a deep multi-year stockholders deficit. This tension between historical narrative and current operational reality creates a fascinating backdrop for anybody tracking high-risk, high-reward equities. When you look at modern online investing, individual brokerage accounts are flooded with retail participants looking for the next microcap to surge on social media hype. Platforms like the Robinhood app or SoFi Invest have made it incredibly easy to execute trades on highly volatile penny stocks, but self-investing in this tier of the market requires intense balance sheet analysis rather than chasing simple price charts. The trading action on Friday saw a heavy volume of over 15.2 million shares changing hands, which towers over historical averages and points toward a sharp increase in active trading interest. This surge in volume followed the company's official financial report for the opening months of the year, which detailed a revenue print of over $407,000, alongside a monumental reduction in net losses. To put that in context, the same period last year saw a staggering net loss of over $16.6 million, whereas the current figure was trimmed down to roughly $459,000. This rapid stabilization is exactly what caught the attention of active trading desks across major platforms like Interactive Brokers and Fidelity, where institutional order flows began picking up on the radical changes occurring inside the company's capital structure. For retail investors utilizing standard investing sites, seeing a stock trade under 20 cents usually indicates a company with no remaining options. Yet, the reality of the situation shows a management team executing an aggressive debt-to-equity restructuring plan. A massive piece of the recent upward price movement can be traced directly to the elimination of toxic liabilities. The firm completely wiped out an $8.1 million preferred obligation tied to its international business transactions by structuring an agreement for the future issuance of approximately 10 million shares of common stock. Furthermore, its outstanding Series A preferred stock liability was aggressively reduced by $8.4 million. These structural maneuvers effectively forced a $17.3 million improvement in total stockholders' equity, bringing the final balance sheet equity to a positive $2.17 million. This matters immensely because it directly answers the listing compliance issues that threaten to force the equity off the exchange. The broader market expected a catastrophic delisting or a forced liquidation, but reality showed an executive team using sophisticated equity issuance strategies to save their listing status. Navigating these types of complex restructurings is precisely why some market participants seek professional investment help or transition toward automated platforms like Schwab Intelligent Portfolios, though active traders on the Interactive Brokers platform prefer the raw control of managing these microcap swings manually. Understanding what this business actually does helps explain why insider accumulation has suddenly picked up. At its core, the company specializes in developing and manufacturing high-power, high-brightness blue laser systems. Traditional industrial lasers rely on infrared wavelengths, which struggle with severe thermal distortions and low absorption rates when working with highly reflective materials. The blue laser technology pioneered by this firm operates at a wavelength where metals like copper, gold, and aluminum absorb energy up to 20 times more efficiently than standard infrared systems. This allows for incredibly fast, defect-free welding
and advanced additive manufacturing in industrial environments. However, the commercial industrial sector has been slow to adopt capital-intensive hardware changes, which is why the legacy business model underperformed for several quarters. Comment below how many shares of Nuburu you currently hold in your personal portfolio, or if you prefer sticking to larger technology names in the current market environment. The operational shift that changed the narrative entirely was the decision to pivot this unique blue laser technology directly into the defense sector, targeting directed energy weapons, counter-drone systems, and tactical mobile manufacturing units. The macro environment for defense technology has created an opening that this microcap is explicitly trying to capture. Through a high-profile joint venture with Maddox Defense, the company has entered a funded prototype build phase for a mobile additive manufacturing container. The goal is to provide military operations with the ability to 3D print critical replacement drone components and tactical parts directly in the field, bypassing traditional supply chain vulnerabilities. This initiative targets a massive addressable defense market, and government demonstrations are slated to begin later this year. Additionally, the company has integrated its high-power laser tech into counter-unmanned aerial vehicle platforms designed to neutralize hostile drones using non-kinetic directed energy. This expansion into defense mobility and electronic warfare is the exact reason why the company's asset base expanded to over $76 million by the end of the first quarter. When retail traders use a basic individual brokerage to buy shares, they often view the asset through the lens of short-term price fluctuations, missing the long-term defense contracts being built behind the scenes. Looking at the broader landscape of modern markets, the distinction between high-growth industrial tech and microcap distress is frequently blurred. Many self-directed accounts on Robinhood stock trading look for simple technical breakouts, while investors using Fidelity Investments or specialized Fidelity Wealth Management Advisory tend to focus on larger, highly liquid blue-chip equities. When you analyze a company of this size, you are looking at an extreme option contract disguised as a stock. The primary risk factor remains the dilution required to fund these large-scale defense initiatives. Stockholders recently approved an amendment allowing the board to execute reverse stock splits to maintain price compliance, alongside a proposal authorizing the issuance of up to $50 million in securities through non-public offerings at a deep discount to market prices. This means that while the operational turnaround is tangible, early equity holders face the constant threat of supply expansion in the total share count, which can suppress per share value even if the market cap of the company rises. The future outlook for this stock depends entirely on how effectively management converts its current $6 million pipeline into binding, cash-generating government contracts. If the counter-drone demonstrations succeed over the coming months, the company could secure institutional backing that shifts it out of the penny stock category entirely. Conversely, if defense procurement cycles drag out longer than the company's remaining cash runway allows, further dilutive capital raises will be inevitable. This delicate balance between severe structural dilution and a high-stakes operational pivot is what makes the asset a prime example of market tension. The public narrative remains hyper-focused on historical underperformance and exchange warnings, while the unfolding reality shows an aggressive push into high-demand national security tech. To summarize the core dynamics at play, the recent trading closing at $0.1969 highlights an equity that is highly sensitive to breaking fundamental data. The initial market expectation was that the firm would crumble under its listing non-compliance and heavy debt loads. The unfolding reality has completely defied that view, marked by an absolute erasure of the multi-year equity deficit, the initial generation of commercial revenue from new subsidiaries, and a clear tactical focus on the multi-billion-dollar counter-drone market. For market participants tracking this microcap through various digital platforms, the choice comes down to whether the current balance sheet stabilization marks a permanent floor or a brief pause in a long-term capital struggle. The structural transition from a simple industrial toolmaker to an integrated defense tech provider has changed the entire calculus of the business, leaving the final outcome to be determined by real-world government contract wins in the quarters ahead.